Okay, so good morning, everyone. Welcome to the macro snapshot. We are June the 18th, 2024, recording this at about 6:50 in the morning of June the 18th. Okay, guys, not a lot going on. We have the US holiday coming up tomorrow on Wednesday. So there could be less liquidity and less market action. A lot of the markets are closed or semi-closed tomorrow. What we did have overnight, we had the RBA, and keep in mind that the RBA is still one of the most hawkish central banks in the developed world, along with the Reserve Bank of New Zealand. And just kind of interesting. We look here, just looking here, the daily chart on the Australian dollar futures versus the US. You see not a huge reaction, trading in the middle of the range. It had gone a little bit green, and that just because the RBA, as expected, did not cut interest rates at all. But the governor, Michelle Bullock, essentially said that inflation was still too sticky. They didn't rule out anything, and that yes, they had indeed discussed the possibility of possibly hiking at the meeting, which they probably won't do. But still, if you look at the forward overnight interest rate swaps, the RBA is still probably one of the most hawkishly priced. So just kind of interesting there to see the Aussie dollar just change trading in the middle of the range against the US dollar at the moment, and possibly being held back a little bit about some slightly weak data out of China over the last few days. But if you look at against the cross pairs, so for example, if you look at the against the euro, you see the Aussie actually doing quite well. And it looks like a bull flag. Sorry, that's the against the yen. You see the Aussie doing quite well. You see here the euro down a little bit. And you've got to say to yourself that, if there's going to be sort of political uncertainty, at least until the elections in France, and if, the Australian economy continues to do quite well and maybe things pick up in China a little bit, one could possibly even see that the euro Aussie sort of breaking down below this level of 161. That's something interesting, especially if there's any extremist party gets in. I think that will have no problem, the euro Aussie going down through this big support there. Where the Aussie did do quite well was against the cross pair of the against the New Zealand dollar, the Kiwi. You see here big sort of uptick there. So there's the main reaction there, just in the Asia Pacific sort of area there. And if we look at the Aussie also against the where is it? The JPY, you also see doing quite well. So that's just something to keep an eye on. And I think that if there's going to be any weakness in the US dollar, maybe we have retail sales day, which is weak, or maybe if the Fed goes into a cutting cycle. I think that, as long as there's going to be uncertainty in Europe, I think that the Aussie dollar is quite far from Europe in terms of political fallout. And basically, if the global commodities remain relatively supportive, I think that over the summer and spring, the Aussie dollar could do, quite well compared to some of the European currencies. Of course, once we get closer to the election, and if, it seems that maybe Trump is going to win, and Trump, might want to slap more tariffs on China, Australia obviously has a lot of exposure to China. And so maybe the Aussie dollar, as we get closer to November, so into that sort of autumn, sort of October, November kind of period, the Aussie dollar could be under a bit more pressure as the market starts to look a little bit about the fallout with, maybe sort of Trump-backed tariffs on China. But anyway, just for the next month or two, I think the Aussie is relatively well placed. Now, of course, what we do have today, we have retail sales. That's probably the last major data point before the holiday. And there's not really a lot of data this week until we get initial jobless claims on the Thursday, and then on the Friday morning we get the S&P Global. But just for the moment, this is the main one. So let's just have a look. Again, the market's going to be interested to see if this whole narrative of the US, the consumer staying strong, remains in place. So let's just see what, as always, the most important one's going to be the retail sales, excluding automobiles and gas. The control group as well is pretty interesting, just because that excludes the home renovation. So I'll be looking mainly at the auto and gas and the control group here. And as you guys can see, last time was pretty soft in negative numbers, minus 10 basis points, minus 30 basis points. Both of those numbers are expected. The consensus is that they'll rise, about 0.5% or so. So just going to be sort of interesting to look at that. And so in terms of market reaction, I think the market will view that very simply as the real economy. And if that remains robust, I think it's going to be supportive for stocks. I don't think at this point this is really going to change the Fed's thinking too much. The Fed at this point is extremely focused on inflation data. And I would say the second mandate, which is which is employment. So at this point, if these retail sales are strongish, I don't think that will stop the Fed from cutting. And on the other hand, if they're weak, I think it's not necessarily going to lead to the Fed automatically sort of cutting interest rates. So I think here the market might react in this that the bond market will react in a sort of, good news here is going to be maybe slightly negative for the bond market. And I think the long end is going to react more because the long end recently, from what I've been seeing, has been reacting more to the short end from sort of real economy data. So I think any strong numbers here, we could see, let's say the 10-year or the 30-year, under a little bit of pressure rather than the front end. Not to say the front end won't go down. On the other hand, if we see anything sort of weaker here, I think this could give a little boost to the bonds. US dollar, I think the reaction is going to be fairly straightforward. A higher number should be strong for the US dollar and the opposite. For gold, similar kind of situation here. For equities, I think what I've been noticing is that sort of so-called real economy data is a bit more sort of tied, much more highly correlated to let's say the Russell. So I think that's something, and which is a bit more of a proxy for the real economy. So we saw yesterday that the US equities still outperforming Europe. We see although just talking about Europe, just a little bit of a pause at the moment. You see the Euro Stocks 50 coming up a little bit. But yesterday, it's just pretty relentless, these stocks in the US. At this point, they're getting into this Fibonacci extension. You have to start looking at things to say, well, okay, let's say we look at a weekly, maybe like a Bollinger Band on the weeklies or something like, just to see where these might be going. Let's have a look here. And you see now it well outside the Bollinger Bands. They're technically a little bit oversold on the weekly. So this, in theory, from a technical point of view, I would say is due, sort of quote unquote, for a pullback. But we know that oversold conditions can continue. As you see, normally it would not surprise me to see this just sort of pull back to the sort of the midpoint of the Bollinger Bands. You see Nasdaq is extremely strong and outside the Bollinger Bands. So at this point, I think we all know that the US stock market is going to be fairly dependent on Nvidia, sort of Apple, Meta, the big tech stocks. I think that's no surprise to anyone. So really, I think the action could be in something like the Russell. You see here, very much outperforming the big brothers. And again, on the retail sales here, I think it's sort of and this is a number which is going to react a little bit more to the retail sales. So it continues to be, buying those sort of tech behemoths, those large cap tech stocks. And I think it's pretty simple. We have to just be looking at those charts, and as soon as they start to show weakness, that could be reflected in some of the other equities. The other equity indices. So if we look here at Nvidia, what is interesting is that just sort of on a technical level here, what you guys can see is that I mean, there's different ways of looking at it. You could look at a fib extension from, something like this, if you want to look at a longer term one. And you can see that from that kind of perspective, it is deeply sort of oversold. On the other hand, you could say that on the Bollinger Bands, there's still a little bit of upside on the daily Bollingers here. So it's, technically could go up a little bit more. But this is definitely something which we should be looking at hawks, because I think any weakness with, let's say, the Googles, the Nvidias, the Broadcoms, these kind of stocks, that could be the pause just for a little pullback, not necessarily come kind of collapse, but for a little pullback in, let's say, the Nasdaq and the ES, obviously. Just in terms of other stuff, generally in Europe, we've seen a little bit of risk returning to the market. And why is that? Probably the easiest way to look at that, if I just look at my little sort of Macron thing here, and what we can see is that the French bonds just stabilizing a little bit here, not really going up a huge amount, but definitely stabilizing from the lows. We can see the spread here. This is the French versus the German. That has come down, and it looks like that 80 basis point spread is really going to be the line in the sand. That goes back to the 2017 elections. Very, very important there. But as you guys can see, the last couple of days, that spread has come in. We also see the Italian spread has come down a little bit. We can see that the EWQ, which is the ETF for the French stock market, has basically more or less bounced. It almost got down to that 61.8% fib. And as you guys can see, the last couple of days just kind of consolidating. Personally, until and unless we get a clear sign that the centrist parties will gain the majority, I think it's going to be difficult for all of these markets to rally. And here, just while we're talking, look at the CAC 40, which has gone up a little bit as well. This is the French index. So I think these markets are going to, maybe just sort of trade still on the heavy side, maybe a little bit of a bounce, but nothing sort of major, as I say, until and unless we get a clear sign that Macron's party has regained the initiative. And we can see here just the French the yield on the French 10-year just sort of coming down a little bit from the highs as well. So all in all, a little bit of a risk coming back slowly, delicately to the French markets and the European markets. But I think, again, that's going to be limited until we get more information. In terms of other markets here, we see, let's just look at the 10-year in the US. You see that in general, just sort of coming off a little bit as risk creeps back into the market with the strong US stock prices. The retail sales could have something to say about that. Oil yesterday had a pretty nice breakout day, getting to quite a key level here. Let's just take those Bollinger Bands off. We don't really need those, but as it's still well inside the Bollinger Bands just while we're looking at it. But oil coming up to a pretty interesting technical level. Had a bit of a sort of a bull breakout yesterday from the bull flag. But again, coming up to a very big sort of Fibonacci, the 0.32 kind of retracement here. So this is an interesting one. So let's just see what happens here, because this is, I don't really know if it's going to break through. We're starting to see, because here's the problem. So we have technical resistance here. If you go all the way over at about the $80 mark on the WTI, the problem here is really gasoline. You see gasoline, starting to push up, but basically refining margins are down. If you look at the 3-to-1 crack spread here, which is basically, a combination of crude oil, heating oil, and gasoline, you can see that the crack refining spreads here are very, very low. And this means that refiners have been producing too much for the market. There's a glut of refined products. And therefore, these refiners are, they're not having their full runs. And basically, that means that future demand for crude is going to be on the lowish side. Now, on the other side, you're starting to see a little bit of a pickup for summer demand. But I think really for crude oil to break a lot higher, this is my personal view, to break out through here, we need to see these crack spreads. And this is, as I said, the 3-to-1 crack starting to pick up a little bit, because that will indicate more demand from the refiners going forward. So keep your eye on the crack spreads. Keep your eye on gasoline, because I think really a true further breakout needs for crude oil needs both of those other markets to be pushing higher. In terms of the US dollar, remains pretty strong. Maybe the retail sales today will give a bit of direction either way going into the Juneteenth holiday tomorrow. But I think in general we see that the dollar index here, is still pretty strong. Broke out of this range. This could be some kind of bull flagging formation here. And again, euro had a little bit of a pop, but still very much trading a little bit on the heavy side there. And we already talked about the Aussie dollar. Just finally, guys, a little bit of weaker data coming out of China. So you see something like copper breaking down below what I regard as a fairly key point. This is the conjunction here of the two fib levels around about the 4.43 on the US, the high grade market here. So copper breaking down below. And until and unless we get strong Chinese data and a lot more sort of risk on globally, I think copper here is definitely in danger of going down, testing this level at 4.25, 4.25 down here, because it looks pretty heavy. Now, along with that, you see that silver also starting to trade a little bit on the heavy side, getting down towards a very key level at about 28.80-ish, which again is the conjunction of these two fib zones here. So I think that the industrial metals have been down over the last 48 hours. So your aluminium, copper, lithium, well, lithium's not exactly in that basket, but a lot of these sort of industrial base metals have been down, and it's dragging down silver. And so you see here that gold is, doing slightly better, but still heavy. And this to me does look like sort of a bear flag. And I think gold is in danger of pushing down. And who knows, maybe the retail sales this morning, if that's on the strong side, that could be the catalyst, which just pushes all of those metals down into the next level lower. Okay, I'll leave it there, guys. Have a great day, and we should be talking soon. Thank you.